If you want to invest in the stock market but lack experience, it can seem complicated and risky. I believe that every investor should own stocks. However, there's a right and a wrong way to buy them. This podcast will explain stocks, their advantages and disadvantages for investors. I'll review 5 simple ways to own stocks while taking as little risk as possible, so you can confidently build wealth for the future. Welcome back to episode 938 of Money Girl. I appreciate you being here and spending time with me. I'm Laura Adams, an award-winning author, on-camera spokesperson, money speaker, and founder of The Money Stack, a Substack newsletter. I've been providing personal finance tips and advice on this podcast weekly since 2008 with over 44 million downloads. You can learn more, ask your money questions, and sign up for The Money Stack at lauradadams.com. Newsletter subscribers automatically receive my Money Success Toolkit with the exact templates I use to manage money. So I hope you'll download that and enjoy it. So let's talk about stocks. They are known as a share or equity because they represent ownership in a company. A company might issue stock to raise money from investors. For example, NVIDIA might want to launch a new product or invest in research and development. Selling shares of stock to the public allows a company to raise capital without incurring any debt. Therefore, if you buy shares of NVIDIA stock, you purchase a small piece of the company. You become an equity holder, which is why stocks are called equities. There are different classifications of stock based on the rights that owners receive, but the 2 main types are common stock and preferred stock. Common stock is ordinary equity that represents basic ownership in a company. It typically allows you to vote on critical company issues, and it may come with dividends. Not all do, but it may come with dividends, which is a share of company profits that get paid out on a regular basis to shareholders. And there's preferred stock, which may not come with voting rights, but it typically pays dividends. Preferred shares give owners a higher claim on the company's assets than common stockholders in the event of something like a bankruptcy. There are hundreds of thousands of companies that offer their stock on public marketplaces known as exchanges or stock markets. The New York Stock Exchange is the world's largest stock market. A company's stock price can be influenced by many factors. Some key influences include its performance, of course, like its earnings reports and demand for its goods or services. If a company is profitable or investors believe it will perform well in the future, they may buy more of its stock, and that pushes the price up. Alternatively, if a company reports lower than expected earnings or maybe it gets some bad press, investors may sell their shares, resulting in a decline in the stock's price. Our global and national economies also affect corporate profits and consumer behavior. For instance, the broadcast news, a social media trend, or recommendations from a financial analyst can significantly influence an investor's perception of a company and impact its stock price. To sum up, a stock's price is constantly moving, and it's influenced by a complicated interplay of its financials, the broader economy, and the collective psychology of investors. So when we're talking about stocks, investors typically categorize them based on various factors, like a company's size, its location, its profitability, and potential. So we'll go through some terms that characterize different types of stocks. You'll often hear about growth stocks. These are shares of companies that are expected to grow faster than the overall market. They often reinvest their profits back into the company to continue growing, and they may not pay dividends to shareholders. Some examples of growth stocks include Uber and Meta. There are dividend or income stocks. These are shares of pretty mature companies that regularly pay dividends to its owners in the form of cash or additional shares of stock. Some examples include Procter & Gamble and Coca-Cola. Blue chip stocks are shares of large, well-established, profitable companies that have had a history of regularly paying dividends to shareholders, like Johnson & Johnson and Pfizer. Value stocks are shares of companies that appear to be trading at prices lower than the market or lower than their competitors. Investors purchase these in the hope that the market will eventually recognize their value, causing their prices to rise significantly. And there are large cap stocks. This refers to shares of companies with a market capitalization exceeding $10 billion. You calculate market capitalization by multiplying the current price per share by the total number of a company's shares outstanding in the market. Some examples of large caps include Apple and Microsoft. And there are medium and small cap stocks. Small caps are shares of companies with a market capitalization usually under $2 billion, such as Sally Beauty and Kohl's. And of course, there are domestic and international stocks. Internationals are shares of companies that are based overseas and not listed on a United States exchange, like the New York Stock Exchange or the NASDAQ. Some examples include Shell and Nestle. The primary advantage of investing in stocks is that they're a convenient and straightforward way to earn money. For instance, the Standard & Poor's 500, or S&P 500 for short, is a stock market index that tracks the performance of 500 leading companies in the United States. Since the mid-1920s, the average annual return of companies listed on the S&P 500 has been approximately 10%. So stocks are excellent investments when you want to build wealth over the long term. No other mainstream investment, such as bonds or money market funds, outperform stocks over the long run. Now, the downside of investing in stocks is that their prices can be volatile due to short-term fluctuations in trading volume. As I previously mentioned, if a company releases a lower than expected quarterly earnings report or has a product recall, investors can quickly sell their shares, causing the price to drop. While investing in stocks always carries some amount of risk, there are ways to mitigate it, and that's what this show is about. So I want you to consider 5 ways to purchase stocks with less risk. Number 1, don't buy individual stocks. Buying an individual stock is significantly riskier than owning a diversified portfolio of many stocks. If your entire portfolio is tied to the performance of just one company's stock, and it declines due to economic conditions, bad management, or a lawsuit, whatever the reason, your investment could be wiped out. In other words, the volatility of a single stock could create an emotional roller coaster. Additionally, it requires time and expertise to research and analyze a company's financials and their market potential. For most investors like me who don't want to make a career out of stock picking, buying individual stocks is a very bad idea. Trying to find 1 or 2 winning stocks is really gambling. It's not strategic investing. However, a diversified portfolio that spreads your money across different companies and industries reduces the impact of any one underperforming stock. Diversification protects you by smoothing out the performance of winners and losers over time. Now, if creating a diversified portfolio sounds difficult or time-consuming, don't worry. Buying shares of diversified funds that I'm going to cover next is a really easy and inexpensive way to invest in stocks. Unlike other types of investments like real estate or businesses, you don't need much money to buy stock funds. So the second way to reduce risk when you own stocks is to buy a stock mutual fund. Mutual funds are collections of assets managed by a professional. A stock mutual fund is made up of hundreds or even thousands of different company stocks. They're exclusively sold by fund families. You probably heard of Vanguard or Charles Schwab. These are fund families. Shares of a mutual fund can only be bought and sold at the end of the trading day when the fund's net asset value is calculated. A mutual fund might focus exclusively on stocks classified as growth, income, international, or large cap. It could be as narrow as only owning stocks in specific industries like technology, utilities, or real estate. Be aware that all mutual funds charge fees, and these are known as an expense ratio to cover costs like administration and management. For instance, a 2% expense ratio means that 2% of a fund's total assets will be used to pay expenses. So the problem with fund fees is that they reduce your net earnings. They get taken out of your earnings. Therefore, it's wise to select funds with relatively low fees, ideally 1% or less, to earn returns that are as high as possible. Okay, the third great way to own stocks is to buy a stock exchange traded fund, or ETF. An ETF is similar to a mutual fund because it's also a collection of assets. However, unlike a mutual fund, which can only be bought and sold through a fund family, an ETF trades on an exchange and experiences price fluctuations throughout the day, just like a stock. So it can be bought and sold at any time the exchange is open. Compared to a mutual fund, ETFs typically have lower expenses, which get passed along to investors in the form of lower fees. A fourth great way to own stocks is to buy an index fund. An index fund aims to match or outperform a particular index, like the S&P 500 that I mentioned, or it could try to match the NASDAQ or the Russell 2000. Index funds may be made up of hundreds or thousands of underlying investments and typically come with low fees, which makes them quite popular. An index fund can be either a mutual fund or an ETF, but it's always passively managed. So instead of having a fund manager actively selecting individual stocks and attempting to outperform the market, the goal with an index fund is to closely replicate the performance of an index. So index funds typically use a computer algorithm to buy and hold the same stocks in the index in the same proportions. Therefore, if Amazon accounts for 4% of the S&P 500, an S&P 500 index fund would allocate 4% of its portfolio to Amazon stock, again, trying to mimic the index as closely as possible. And when the underlying index changes, such as when a new company is added or removed or the weighting shifts, the index fund also adjusts its holdings accordingly to maintain a mirrored strategy. It would be challenging for the average investor to purchase hundreds or thousands of stocks independently. So index funds provide a very simple and cost-effective way for investors to own a very diversified portfolio of stocks. And the fifth great way to own stocks is to buy a target date fund. Target date funds are also known as life cycle funds. These are some of the newest and most innovative investment options. You can buy them within a mutual fund family or even as an ETF, and you'll often see these within retirement accounts. You'll recognize a target date fund by its typical naming convention, which often includes a year, such as the Retirement 2040 Fund or the Retirement 2055 Fund. The date should correspond to when you want to retire. For instance, if you're 35 years old and want to retire in 30 years from now, in 2055, you choose the fund with the target date closest to your desired retirement date. What's unique about target date funds is that they're made up of different types of investments, such as stocks and bonds, that slowly change allocation according to a selected time frame, such as your estimated retirement date. This is known as the fund's glide path that gradually and automatically reduces the proportion of stocks and increases the proportion of bonds and cash as the target date approaches. That helps you become more financially conservative as you get closer to retirement. Because target date funds already include a mix of asset classes, you typically only need to own one of them. The right amount of stocks is baked into the investment, making it an easy, sort of one-size-fits-all solution. A common question investors ask is, how much stock should I own? Well, the answer depends on things like your risk tolerance, as well as factors like your age and when you want to retire. In general, the younger you are and the more time you have to go before retirement, the more stock you should own. And by stock, I mean one or more of the stock funds covered here. Remember, I don't recommend buying individual stocks. So if you're young with many decades to go before retirement, owning a high percentage of stock funds in your portfolio can help you achieve as much growth as possible. Though prices will go up and down in the short term, you're likely going to see prices trend up and give you an impressive return over time. But if you're nearing or already in retirement, you want to take a more conservative approach to preserve the wealth that you've accumulated. So that doesn't mean eliminating stocks from your portfolio entirely, but owning a lower percentage of them and allocating more of your portfolio to bonds and cash or guaranteed income sources to preserve the wealth you worked hard to accumulate. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and we've got a great team I want to thank. Steve Rickyberg audio engineers the show. Holly Hutchins is our director of podcast. Morgan Christensen is our advertising operations specialist. And Nathaniel Hoops is our marketing contractor.